Hello, this is the Accredited to Accredited show, where real investors, not academics, help other investors to achieve financial freedom and grow their wealth. Here's your host, Gina Lofton.
Hello, everyone. I am so excited. I have Ken McElroy from MC Companies here, and I just want to introduce you to my best partner. He has spent over 2 decades running a successful real estate business and in the real estate world, from investment analysis and property management to acquisitions and development, and has over $750 million of investment dollars in real estate. And Ken offers an amazing, unique perspective on how you'll get the biggest return on your investment. So welcome, Kenny, to the show for accredited and non-accredited investors. And I'm glad to have you here.
Hey, thanks. It's great to be on the show. Congrats on your success.
Thank you so much, and same to you. So listen, I actually went out to my audience and I told them that I was interviewing you and I wanted to get their questions. So we're going to start off with asking you some questions. And thank you all of my listeners that sent in the questions. Aaron, Carl, Michael, Michelle, Peter, Daryl, and Eric. I consolidated them all for succinct, so I can ask them succinctly. So let's just go ahead and get started. So I want to know, Kenny, what is MC Companies? If you could tell us a little bit about that. How many buildings do you own? How many units? And just give us a little 60 seconds.
Sure. Well, I think it's important to start off that I started with a 2-bedroom, 2-bath condo that I bought on my own with my own money. And now we have 10,000 units, 300 employees, primarily in Texas, Oklahoma. We're a ground up, we build them, so we do ground up construction. We own properties throughout the Southwest and Texas, Oklahoma, Nevada, and Portland, Oregon. And I've been in it for over 20 years. I started off in property management and, made the leap over 20 years ago to buy my first multifamily. And I've learned a lot and never looked back.
Wow. Well, congrats. That's amazing story. So do you have another partner that you have this business with? And if so, who is that?
Yeah. Well, he's amazing. His name's Ross McAllister. And, when I first started in the business, I had my own company and Ross had his own company, and his last name's McAllister and mine's McElroy. So that's why we call it the MC Companies. And we're equal partners, and his primary role in our organization is to assist on the ground up construction properties, and also to handle some of the legal and tax, although I'm involved in all of that, of course. And then my primary job is to identify deals, look at acquisitions, and run the operations, and then communicate to our investors.
Excellent. So what is the secret sauce to make that work between you and Ross? I mean, finding a partner that you can be successful with is not easy.
Well, partnerships are hard, and I've been in a lot of different ones over the years, and candidly, I think what happens with partnerships is a couple of things. One, I think people don't deliver what they say they're going to deliver. So oftentimes they sell themselves, or they think they can. And I'm not saying that they're lying. I just, they just don't deliver. Ross delivers. And so, Ross is a general contractor. He did a lot of ground up construction before we met. And And so, if Ross says he's going to do something, he does something. And if he doesn't know how, he figures it out. And I think, honestly, partnerships can be that simple. And I think a lot of times people are really focused on the money, and they're focused on, being an owner or whatever, and their ego and everything. You know, and they don't deliver. And so the expectations for me with Ross is extremely high. And because of that, we have a great respect for each other. We trust each other, and our partnership is pretty powerful.
Yes, I can attest for that. And just for the audience, just so you know, I am a partner in many of Ken and Ross's properties, and they have been very successful. So I just wanted to be forthcoming with who I am in the relationship there, so you know that. So let's just talk a little bit about what you're doing now, Kenny. There was questions from my audience as to what you're buying, and if you're buying multifamily, if you're building multifamily, and maybe if you could share some light on what it is that you and Ross are planning.
Sure. Well, I think that, the interesting thing is just because you have the access to money doesn't mean you should do anything. And I think that, and just because the market was going up last year doesn't mean that it's going to again this year. So we don't believe that it's a good time to buy multifamily personally. That's our own philosophy. And there's a lot of reasons behind that. One is capitalization rates are so low, occupancies are all-time highs, and rent growth are at all-time highs. And then of course, interest rates are all-time lows. So those are four things that are probably at their peaks, although interest rates have creeped up a little bit. But generally, we just don't feel like it's a good time to buy, and we haven't, as you know, for about a year and a half. We are looking, and we still continue to look. It's not that we're not active. We actually had a long meeting yesterday with CBRE in our offices for that exact issue. But what we think is best for us right now are some of this ground up construction, because we do build, and we're building for, about a 6.5 cap. And the market is selling at below 5. So there's a lot of value right now for us in the construction space, but we're not seeing it on the existing inventory.
Gotcha. And are you looking at specific geographies for even ground up construction?
Well, we just as a company don't feel comfortable branching out nationally for construction. So we're focused on Arizona, and of course Arizona is huge, so it's not really a bad choice. It's just there's so many different markets in Arizona, from Tempe to Phoenix to Glendale to Chandler to Flagstaff to Prescott to Tucson, and and so on and so on and so on, and Scottsdale, and so, which is where our office is. So there's a lot of land, and there's a lot of potential here in Arizona. So we're just kind of focused locally. And we have about 100 million under construction right now.
Wow, that's congratulations. As a matter of fact, Kenny, right before our call, I was on a webinar with Yardi and looking at different geographies, and they really were focused in on the Phoenix market and calling that one of the high-tech, hubs of the U.S. So it's kind of interesting.
Yeah, and they're certainly trying to make it so.
Yeah. So you're in a great area. So what signals would you look for to go back into multifamily, like price per door, number of folks invest in finals, from your broker contacts? I mean, are there any list of economic indicators that would suggest, okay, now is the time for me to go back in and look at buying versus building?
Yeah, it's a very good question. Well, we always try to start, Gina, with the return to the investor. So, and then we work backwards into everything else. So, both the debt and the equity, they need to be paid back. And you always got to keep that in mind. You're always the real reason that we're doing this is obviously for everyone to make money, and if the projects don't make money, then that's actually the reason. So now, what does that mean? What it means is that if if a broker is saying that rent growth is going to be 2 or 3 or 4% per year for the next 3 or 4 years, we might disagree. But you can make the numbers whatever you want to make them. The broker might say that your expenses are going to go down. Again, just an opinion. We don't necessarily think that's the case. Um, and so you start to look at indicators like, what about, what's happening with rent, for example. Now, rent's different in Scottsdale than it is in Tucson, than it is in Chandler, and it is in Flagstaff. So, very different markets. And then as you start to look, you'll see that North Scottsdale, Central Scottsdale, and South Scottsdale are very different. So, real estate's very localized. You have to know all those little nuances, and all those little things make up whether or not a property is going to be good or not. And of course, like anything, if you pay too much for it, then it's not going to do as well. And so right now, what we're seeing is unrealistic projections by brokers and sellers, and a lot of money buying properties right now. So that's driving the prices up. So the prices are high, the expectations are high, and we just don't think that it's a good time to buy, based on what I started the question with, which was, what are the investor returns? Because at the end of the day, whatever you buy it for, whatever it's operating at today, whatever the cost of your debt and equity might be today, it'll show you what the return is. So it's not rocket science. It's not like we think it's going to do this. You can actually take a property today that's operating today, put new debt and equity on it, and see what does it produce. And so the sales job right now with everybody is, well, we think we can improve it. And so that's actually the big question mark, is can they or can't they, and is the market going to support them?
Yeah, and that's what gets me into this definition of value add. I think that term is used very broadly. And I have a definition of it, and I think you and I share the same definition, but it may not be the same thing as the definition of what these brokers are saying it is.
That's another good observation. So, value add, I'll tell you what I think it is. It's now a catch-all phrase for everything.
Yeah.
So, for me, value add is taking a 20-year-old building and putting $6,000, $7,000, $8,000, $9,000, $10,000 inside of the unit in the form of new appliances, new paint, new flooring, and new countertops and those kinds of things. And then knowing that your rents are going to go up $100 or $150 a month. That to me is what a value add is. So in other words, it's no different than renovating the inside of a house and selling it for more. It's the exact same thing. Now, it's interesting because you can do that in markets today and not get any more rent. So you have to be sure that you're going to get more rent. So, but typically you can take something that's 20 or 30 years old, spend money on it, and charge more. But guess what renters are not going to pay more for? They're not going to pay more for a parking lot. They're not going to pay more for a roof. They're not going to paint more because you painted the outside, and they're not going to pay more for a kid's play area or a dog park, okay, or a new gym. They're going to expect those things, and they're going to pay more for interior upgraded units. And so that's what I feel like a value add is. What people are, that buzzword is used a lot right now, and it's all over the map. Uses it very loosely.
Yeah, I've seen that, and it's just, I call it kind of like putting lipstick on a pig, and I think it's not being completely forthcoming with what our definition is. So it's a mismatch in general.
Right.
Yeah. So let's go into value add a little bit more as to how difficult is it to do that type of value add today versus 5 to 10 years ago, when you would see many more opportunities where you could increase the NOI. And what are some of those factors, such as high valuations, cap rates that are rising, interest rates, and flat income growth, for example? Are you seeing those things that's making you not see value add opportunities as much as you used to?
Yeah, I think again, it's actually a pretty simple business. And I think sometimes people tend to make it really complicated. And what I mean is, we'll just pick on a market, that we're in. Like we're heavily invested in Tucson, for example, and we have like 2,000 or 3,000 units down there. And there are areas of Tucson that everyone wants to be, and it's progressive. Maybe there's a new employer, or maybe it's around the University of Arizona where they're expanding, and or whatever. And then there's areas that are not as progressive, just like in any town. And so the areas that are not as progressive, and you're just not going to get rent growth because you don't have the demand of the renter. So if you have like the area around University of Arizona, for example, there's a big demand, and of course, a big demand for housing and a shortage, right? So just as an example, I'm in the business. I'm paying $1,500 for my son to live near the campus for a studio. And of course, I own a lot of property in Tucson, and so that is very high for downtown Tucson, and near the university. But but if you go 3-4 miles away, that exact same thing is going to be $800.
Yeah.
So I just think it's just real common sense. And so you could you're going to pay more for something, let's say near University of Arizona, but your potential of keeping it full and having higher rent growth and all that stuff will be better. So you know what I mean?
Yep, I see. Okay, no, thank you for that. So
Sure.
let me ask this, because there's different classes of properties, A, B, and C. And right now, the cap rates are kind of similar across those different classes. Are you noticing that same phenomenon? And if you are, how can you explain or reconcile that?
Well, first of all, I think we got to talk about what a cap rate is. Cap rates are just the net operating income divided in whatever the property sells for.
Yeah.
So that's what a cap rate is. And so what's happening, Gina, is that there's so much money chasing apartments that we're getting very, very high prices. And so, we're starting to see these cap rates, super low numbers. As we listed 2 properties, and we had offers in the first 2 weeks at 4.75 caps, and we bought them at 6. And so that extra 1.25 cap is a lot of money for the investors, which is why why we listed them, because I just don't think that these cap rates are going to stay at the levels that they're at. I think they have to go up, so we're trying to sell some properties now and return some cash to the investors, so that hopefully we can rebuy at a later time when they go up.
I see. Okay. Interesting. Thank you.
Uh-huh.
How can one use debt? You use this term debt is tax-free a lot. So can you explain what you mean by that?
Yeah, great question. It's really quite simple. Debt is money that you owe back to somebody, as you know. It could be from a bank, it could be from an insurance company, it could be from a pension fund. You get money from pretty much anywhere, even privately. And so when you borrow or get a loan from somebody, it's owed back. And so you actually don't pay tax on that because it's a loan. You don't pay tax on debt. Now, that's why you just think about it on a single family level. People talk about those cash out refinances on their homes, let's say. Fortunately or unfortunately, a lot of people use those to buy, new furniture or new boats or new cars or whatever. And, I'm not bashing on them for that. But the point is it's not taxable. It's a second mortgage on their house. So that's essentially all you're doing is you're just refinancing and scooping whatever equity you might have and distributing it out. And because it's because it's a loan and that means it's not taxed. So, it's really that simple. Now, if you sell a property and you get all that money back, now you have a taxable event, right?
Yeah.
But as long as you're using debt, it's not taxed.
Yeah. Yeah. No, it's a great way to build wealth fast. Do you know a number or would you be willing to share a number as to what you've actually been able to refinance in the last 5 or 10 years as a result of this, increasing NOI and debt method?
Yeah. Boy, off the top of my head, I would say it's been somewhere between 2 and 300 million.
Wow. Yeah. No, that's significant. And so it's interesting, Kenny. I don't know. So I was doing my cash out refinances here in California before I started investing with you. And now you've turned that same dollar at least 5 times.
Oh, wonderful.
Yeah, exactly. So I would be poor if it weren't for that method.
Yeah, it's a great method. It's the best part is most people don't think of it that way. Most of the gurus, the financial gurus, are telling people to get out of debt, and I think what they mean is like credit card debt. At least I'm hopeful, because the truth is if you look at anybody or most people that have gotten extremely wealthy, they've used debt.
Yeah, and I talk about this a lot, and it's really interesting because my whole entire life, if you think about it, in the last 10 years, has been a benefactor of debt. Even with AT&T buying DirecTV for $48.5 billion, Kenny, it was because of debt, right?
Yeah.
So the whole world has gotten filthy rich with debt, yet many people don't understand this, right?
It is so true. Yep. It's really, if you really think about this and really take it the next step, debt is actually just a form of other people's money. So when when your financial planner puts you in, some kind of vehicle, whatever it is, it doesn't really matter. Or just actually the better way to think about it is a bank. When you put, let's say you have $100,000 in the bank personally, well, that money to the bank is a problem. It's the bank's problem because they owe you interest on it, and it's an expense to the bank. So people don't think of that, but so they save, and that money is sitting in the bank, and that bank is going, oh my gosh, I have to turn this into more money. So they're paying you 1%, and and they're charging me 5%, and that's how banks make money. And so it really is the whole system set up for people to use the money that everybody's parking.
Hey everyone, I've got great news. If you visit us at a2ainvestor.com, go to the calendar tab and you will find all of the upcoming speaking engagements and where to find me. So this year coming up in July 2018, that is just a few months away, I will be at Freedom Fest for the 3rd consecutive year. and on a debate entitled Wall Street versus Main Street, which is better for making money, with Mr. Robert Kiyosaki, Mark Lichtenfeld, and Simon Reeves. So be sure to visit us at a2ainvestor.com, go to the calendar, and find out exactly where I will be to answer any and all of your questions. All right. I look forward to seeing you at one of the upcoming events. Can you talk about this term called syndication? Because I know there are people that one may not know what that is, and others might actually create a business that is a syndication business where, for me, I think it's just a tool to do business.
Yeah, it just depends on, so for me, what happened was, I think everybody has they have whatever they have financially. Some people have no money and some people have a lot of money. But the truth is, if you're trying to buy something, whatever it is, it could be a business, it could be a commercial shopping center, it could be a single family home, it could be a duplex. It doesn't really matter. If you don't have the money, then what you do is you go out and you raise it from other people. And that's all syndication is. It's just a fancy word for raising money. And it's, you're trying to get people to invest in your vision, whatever your vision is, on whatever it is. It can be, for me personally, I'm actually looking at investing in another business right now. That's non-real estate related. I've invested in tech personally. I've invested in gold mines, and all of those were syndications. They're all people raising money independently. And so I do it with multifamily, but I invested in somebody else's business that was on the commercial side and on the self-storage. It's not a business. You invest in the people and the management of the people, and then typically they're raising money for projects, and that's just all syndication is.
Yeah. No, thank you.
Sure.
So how do you go about, not all sponsors are created equal, right? How do you go about selecting your sponsors or the investments that you make? You said it's all about the people. Can you?
Yeah. So I about 15 years ago, I got approached by a $60 billion company to buy my company. That was maybe like 10 years ago. And it's interesting. There's 45 individuals, and they all manage $1.5 billion each. And so one of them came to me, and they wanted to buy me. And so we sat down, and actually we flew to La Jolla, and we met with them. And we didn't even talk about money till the very end. We didn't even talk about the price or anything like that. And the reason I tell you the story is because all they wanted to know was, what my experience was personally, and who was on my team. Those are the two things. And we spent an hour and a half on those things before we even talked about cash or price or anything. And so and of course I never did the deal with them. But that's a whole nother story. But the point is that I learned a lot from them, because that's all they do. They invest in companies all over the world, and they're not concerned as much about the property or the business, or even though they are, it's obviously, but they're not as concerned as much as they are about the character and the relationship and the experience of the team. The culture of the company is so much more important when you're putting money somewhere than the property itself. And I think what happens is most amateurs focus on the deal only. And, so if somebody's new in a business, they're not passionate about it, They don't really have a team around them. They're very, they might be super smart, but they don't have the ability to, there's leadership, and then there's people who follow leaders, right? And it's a big difference. So those are all the things that I look at. And I want to invest in a team, and I want to invest in a vision, not just an individual project.
Yep. Yep. Very well stated, Kenny. So let me first share with everyone that in 2017, MC Companies was ranked number 9 of the best places to work in the country in multifamily. Am I saying that correctly? Is that the
Yeah, that's correct. Yeah.
Congratulations, first of all. That is phenomenal. So can you share with us exactly what that award is and the significance of it?
Sure. Well, thank you. I had very little to do with that. It's the people that I hired and the people that they hired. And it's really a result of our staff and the culture we have built. So the award is, there's these national awards from in our industry from the National Apartment Association and the National Multi-Housing Council. And I think there were over 50,000 companies like ours. And, somehow we made it into the top 10. And it had to do with, I think we needed a minimum of 200 employee submissions. So each, it was based on a ranking of employee feedback only. So, of course, nothing to do with corporate office at all. So, it was all grassroots, and I, to this day, don't even know who voted. I don't even know what they asked them. And we were really fortunate to be in that top 10, and we continue to be one of the top employers in Arizona for the exact same reason. So they're employee-based submissions, through these various programs that are put on.
Yeah. No, thank you so much. And back to, I know you probably don't know about the process, nor do I, but I can say that culture, I am being an investor and coming there every year and your investors meeting, and I feel like it is just phenomenal. The culture that is so ingrained in all of your team. And I want to thank you for really just, protecting investors' capital and making sure that your employees are happy and prosperous, because that's what makes it all work.
Thank you. Yeah, it's a ongoing, day-to-day hard job to keep all that together, as you can imagine. And ultimately, if we can keep our turnover low, our employees happy, and create a culture here that everybody loves, which by the way, is just more fun anyway. But if we can do that, then the results are going to show up in the assets.
Yeah, yeah. Although some days I know that it goes to, you think it's you and Ross. I'm kidding, but no, it's definitely the team.
Yeah, for sure.
So, Kitty, how many investors do you have today, and are you looking for more?
Well, yeah, we have about 1,000 people, all accredited. And honestly, Gina, I wish that we had deals, and we just don't have deals right now. And we're gonna, as I told you, we're selling 10 projects right now, and we're gonna return probably north of $70 million here this year, and back to our investors, and we just don't have a spot for it. So it's unfortunate, but I would rather be diligent and stick to our investing plan as opposed to, just raise capital and put it into the market right now.
I really respect that so much. So thank you. So I'm on a, let's just talk about property management for a moment before we have to cut off. But you come from a property management background, and it would be negligent for me not to ask, how does one, select a good property manager? I know that You've written a book on it, and hopefully the audience all knows that and have read that. But if you could share some.
Yeah. Thank you. I got to tell you, it's it was entirely. I'm so grateful that I came through um, that vehicle, because having a property management background and having been literally on site and dealing with day-to-day things gives me a huge advantage when we're buying properties. But it also connects me to my employees, because I can go out to the sites and I can walk with the maintenance guy and say, hey, I used to clean toilets and paint units, and I did, and the same thing on the leasing and all of that. So the level, people are usually pretty surprised that I've done all those things. And, so I'm really, really grateful that I came up through the property management business. I think it's an incredibly important piece and very overlooked when a lot of people invest. They don't think of the property manager can make or break the property. However, I will just clarify before I go any deeper on that you can overpay for a property and nobody can manage you out of your misery. So, and that happens a lot. So, right now I can guarantee you there are people buying properties and they secondarily think of their property manager and they stick them on the project. And then when they don't produce whatever they told their investors, they're going to fire the management company and they're going to hire another one. And that'll last 6 or 9 months. And then they'll fire them and then they'll hire another one, never really acknowledging that they overpaid. And so, or that the property didn't produce as a result of, they're going to blame it on the management company. And so having come from that environment and understanding it from that side of it, that's part of the reason we're not buying right now. And, so that'll all happen. There'll be a lot of management turnover in the next few years for sure, because those returns that people are buying at today just won't be met. But to answer your question, the management companies, the good ones, are far and few between, and they're really, really, really hard to get and find. And it all boils down, in my opinion, to the leadership of the company, but also the individual. So you can have an incredible individual, and we made mistakes like this, and I'll just give you a quick example. We have one of our asset managers that I would consider to be one of the best ones in the industry. And because they were so good, we started loading them up. You know what I mean? You give them another property, give them another property, give them another property. And guess what? They never raised their hand. And it was my fault for doing it. And guess what happened? Their performance went down, right? Because they're spread too thin. They think they're Superman or Superwoman. And so you can take a good person and you can drive them into the ground with a workload, no problem. So part of my job is to make sure that the people are not overburdened and they're able to do the work and they're spending quality time at the projects, and they're not just running from email to email, to text, from city to city. So I mentioned that because workload is a big piece, and property management companies, believe it or not, Gina, are not very profitable.
Yeah.
If you really think about it. I mean, just think about it on a single family level, like really.
Yeah.
How much money does it if you own a home and the property manager charges you $100 or say $150, right, which is about right?
Yeah.
How much do you think it costs to manage that thing?
Yeah.
You know what I mean?
Yeah.
I mean, just look at the margin there, just at that level, right? So you scale it up. Now there's a little bit more money to be thrown around in the multifamily space, but not a ton.
Mm-hmm.
With these property managers, good ones, are well over $100,000 each, and and you got a full accounting department, and you got a full marketing department, and you got our overhead every month is over $200,000 a month.
Wow.
Just to manage our properties. And that's money that you need to spend in order to get the results. But I could cut it by 50 grand, and be a lot more profitable.
Yeah.
So it's one of those things that you got to look at and say, and so some of the management companies, they'll squeeze down, they'll load up their managers. I mean, I know really good people that have had 15 to 20 properties, and ours manage 7 to 10.
Wow.
And so you can imagine, so you can take people that are really, really good in the business and load them up and make them not so good. So a lot of the little questions are, how many properties do you manage, and how much time are you going to spend on mine, and how long have you been with the company, and tell me about your owner, and how many about your accounting system. Show me a financial statement. How often do you report? Do you do weekly reports? Do you monthly reports? Do you do quarterly reports? Do you know what the goal and the ownership of the owner is? And all those things are questions that you would want to ask if you outsourced your management.
Interesting. Well, thank you for that. So, Kenny, on a personal note, I know that you are applying to be in Casa. Is it Casa or Casa?
Casa, yeah. I just did my court observation today.
Congratulations.
Yeah.
So, for those of you that don't know what it is, Kenny, do you mind explaining what Casa is?
Sure. It's called the Court Appointed Special Advocate, and essentially, it's I get assigned one child that's in foster care or orphaned, and is in the system. Basically, call it the system. And I show up at their schools. I show up at their courts. Oftentimes, they may not have parents. Sometimes they've been obviously either taken away from their parents, or they don't have parents. And so the job of the CASA is to be the one person in their life that always shows up.
Amazing. Well, I was a foster kid the majority of my life. And for all the foster kids that are out there, thank you for volunteering for that program. I think it's phenomenal. What inspired you to volunteer for CASA?
Well, my kids I got one in college and another one that's finishing up his junior year in high school and about ready to go to college. And I'm going to be an empty nester soon. So I wanted to, I wanted to do something. I wanted to stay plugged in somehow. And my friend who just retired last year, he was the head coach of the Arizona Cardinals. Bruce Arians, his wife and him are very involved in the Casa Arizona program, and he convinced me to do it, and so I decided to do it.
Congrats! So you just got approved today?
Well, I actually got sworn in last week. I did my court observation today with the judge on one of the hearings, and then I go through one more class for how to write the CASA reports, and then I can pick my kid when I get back from Africa next month.
Excellent. Well, congratulations again, and thank you again for doing that. So it's wonderful, and good luck. And I'm sure you're going to make someone's life such a big difference.
Thank you. I'm really looking forward to it. It's been a real eye opener too. There's a real need in the system.
Absolutely. So what would Ken McElroy have done if it weren't doing what you do? If you could roll back the clock, let's just say 25, 30 years, and what would you?
I probably would be a teacher of some sort.
Mm-hmm.
Would be my guess. I really enjoy it. That's why I'm a Rich Dad Advisor, with Robert Kiyosaki, and I enjoy learning, and I enjoy teaching. So I probably would be some kind of a teacher of some sort.
Excellent. Well, fortunately, you do have somewhat of a teaching website, and is that called Ken McElroy? And how can someone?
Yeah. So I started this. So actually, what happened, Gina, is I wrote the 4 books, and I speak a lot, and when I can, I go on the road with the Rich Dad folks and Robert and Kim, but I don't do it very much. I'm maybe once or twice a year at the most now. And, cause I have my own boys and I have, my company and all that stuff. And those are more important, more of a priority, at least for me at the moment. So what happens is, as you probably are aware, is that when you put yourself out there a little bit, you start to get a lot of questions. And I started getting a lot of questions. I get a lot every day. And I felt badly because I couldn't answer any of them. I'm just busy, as you can imagine, buying properties, managing people, trying to make all the sports games for my kids and the practices and, all that stuff. It's just hard to juggle it all. So I created the website so that I could actually convert the questions into videos. That's actually how I started. And because I found that most of the questions were all the same, a lot of them. Yeah. I would say at least 50 of the questions are, how do I start? Like, that's a question I get all the time, for example. I'm sure you do too. So in it, so it's been kind of fun. So I created the website entirely to start doing these videos, and then the momentum kind of started taking off with it. And now I've turned it into, a way to teach more and a platform. It was never intentional. It was never a business that I wanted to, like say, hey, I really want to be in this business. But because I am in it, I want to be good at it. And so, I'm throwing the resources at it just like I would on anything. I don't want to put poor quality out there. So it's been great. And then, I have 4 people working on it, not including me, so now that's why I have to charge for it. I wish I could do it for free, actually, but, in order, again, it's just like anything. I have never taken a nickel out of it, and I may never, but the point is it's been fun. It's been really fun to, to employ 4 people in that business and make it grow. And also, it's entirely customer driven. So we get questions from people, and we decide whether or not we want it's video worthy. And then if it is, we do a teaching video on it. And excellent. Yeah, it's great.
Excellent. Well, Kenny, thank you so much. I am approaching my 1-hour time limit, and I wanted to say thank you. And do you have any last-minute parting words that you would like to share with the audience?
Well, I just would encourage them to take action, and thank them for listening and thank them for being part of your culture. And, I think there's nothing better than transferring knowledge. It's, for those that want it, and I would just encourage them to take action too. Don't just study your whole life, do something.
Yeah. Well, thank you so much, Kenny, and to your continued success. And I would love to, get to know your foster assignment kid. And if I could help at all, let me know.
I will. Thank you.
Okay. All right. Have a great and blessed day.
You too, Gina. Thank you.
Thanks for listening to our show. Repetition is the way we learn. If you enjoyed our show, leave us a comment below. Knowledge is to be shared, not hoarded.
I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits. I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits.
Visit www.a2ainvestor.com, where you can get other tools and knowledge.